Mahesh Nandurkar joins us. Let's take a conversation forward. What the house view is, what are they telling the clients to do in this kind of a market when you're really confused about the virus, and how can one really understand margin of safety when we are trading at a substantial premium to other emerging markets and even to historical averages. Mahesh, good morning. Thank you for joining us. Mahesh, why
Good
is
morning,
there a
Nikunj.
sudden change of heart from foreign institutional investors? I mean, I've never seen a market like this where FIs are relentlessly selling and DIs are continuously buying, which means that you've got two pillars in the market, but they both directionally are investing differently.
Yeah, true, Nikunj. In fact, we've been seeing the similar trend from the foreign investor side for pretty much last 6 to 8 months now. I would say pretty much since April 2021 till date. If you look at the last 8 months or so, barring just a couple of months, foreigners have been net sellers in the secondary market in 6 out of the last 8 months. On an overall basis, you might be seeing a slightly better number than what I'm just telling you. And the reason is that the overall number includes the IPO subscriptions. So clearly, the foreigners have been selling down their existing investments to participate in some of these IPOs. But yeah, but in the secondary market, it's been like pretty much one way. And I think banks and financials in general have borne the maximum brunt of that. My sense is that the near-term worry obviously is that these IPOs coming out of India are not going to stop in a hurry. Maybe a few more months. I guess at least. So my sort of worry in the near term is that you will probably continue to see some selling from the FII side. But I think I would clearly go with the directions of the DIs, in the sense that I do believe that the economic outlook is looking very strong. So while the broader market might not really give you very strong returns over the next 1 year or so, uh, but but I think several stocks and sectors will.
Mahesh, why are banks underperforming? The numbers are looking okay, the economy is in a good shape. Nobody can argue that capex has not started. NPAs are looking just about okay. I put everything together, even after the Paytm so called issue, that fintech fever also seems to be becoming more realistic. So banks have never been, it's been never this good for bank, but bank is this eyesore. The bank nifty is down about 9% in last 1 month itself.
Yeah, I clearly agree with you, and I think bank nifty or whatever, the bank stocks in general, I would say are waiting to re-rate. And I think the moment you see the foreigners selling coming down, uh, on one fine day, you might just see, some of the large bank stocks moving up by like 5%, 7%, something like that. So I'm quite bullish now, here on, the banks, because as you mentioned, that sector has, seen very good fundamental trends. And I think it's the technical pressure because of the foreigners selling, which is keeping it, under some kind of a pressure. But my sense is it is a sector which is just waiting to re-rate. So I would be strongly overweighting banks here.
You've just added names like Fortis and Max Healthcare to your universe coverage. Never seen you, come up with hospitals that aggressively. Is this the next go-to sector from your standpoint, given where the entire hospital space is now positioned?
No, so we have been positive on the hospital sector in general for a while, and you're right. I mean, while we have an underweight stance on pharma in general, or pharma and healthcare in general, but within that, hospital is one space we like quite a lot. Yeah, and the reason for that is multiple. Actually, one is that it is a good reopening play. In my view. Secondly, we have also been, seeing, some encouraging sort of bottom-up numbers as well. Some of the hospitals are also kind of participating in this e-pharmacy kind of a theme as well. So I think multiple themes are coming together. So yeah, we definitely like the hospital sector quite a lot.
Good morning, Mahesh. This is Nantara. I also see from the notes, etc., that you've got Motherson Sumi as well as Lupin as part of the top ideas. First up, why Motherson? Is this the belief that the global supply situation has bottomed out? Things are only going to get better. We're hearing about a Motherson Sumi 2.0, the play in defense, etc.
Hi, Nantara. I'll not be able to comment on individual stocks, for obvious reasons. But, what I'll tell you is that in general, we have changed the focus of our top ideas from, to more domestic cyclicals now. So that's why I said, we actually have, underweight on, as I said, like pharma, we have underweight on, energy, uh, and broadly in auto space, the stocks that we like or the sectors that we like are mostly the OEMs. We like the four-wheeler, the best, in the broader sort of an auto sector. And in the two-wheeler space, we have been very selective. We believe that the disruption coming in from the electric vehicles is for real, and that's the reason the two-wheeler, OEMs, we've been very selective, but broadly quite positive, I would say, on the four-wheeler OEMs.
We are seeing one two-wheeler major, Hero MotoCorp, the world's largest two-wheeler, actually be part of the 52-week low stock, aren't we? Amash, appreciate you taking that question. The other one I want to ask you is, and I understand you won't talk stock specific. We also see that Tata Steel has been removed. So even if we don't get stock specific, we'd love to get your assessment as far as the metal pack goes. That's one pack which always has had the jury divided on how to approach.
Yeah, see, the thing is, we have been been cutting our weight on the metal sector for now nearly last 4 or 5 months or so. And the reason for that, I mean, obviously, the news flow that was coming in from China, has been quite subdued. Our sense is that until the Chinese New Year, which is not until early February, which is still about a couple of months ago, a couple of months away. So I would say that metals, would probably look like, a good sector to look at, once we have clarity on the policy, from the China side. I mean, right now, they are still kind of, amidst a bit of a tightening. We are hearing some sporadic news of easing here and there, but it's not really convincing, at this point in time. And I would say that from a broader top-down perspective, I would rather be focusing here on the domestic, stories. I mean, we discussed banks earlier. There are many sort of building material related sectors like real estate, etc., that we can, talk about. But where we have been cutting weights, as I said, is on the global cyclical thing, because of the uncertainties that are there, globally. I mean, I would say that today the domestic outlook is looking far better than the broader global outlook as such. So the only global sector that we are overweight on in our model portfolio is IT services, because it has a very, very strong bottom-up tailwinds as well. But other than that, I would largely be focusing on banks, real estate related sectors, industrial sectors here in India.
But within IT services as well, Mahesh, does it seem like the low-hanging fruit and the easy money is already made? Or do you believe that there are still certain IT companies which make a case for re-rating perhaps in terms of earnings growth, and that's going to push the sector forward from here?
No, you are right that easy money has probably been made. Uh, in fact, I would say the easy money has been made not just in IT sector, but broadly in the markets as a whole. So the kind of returns that we've seen in the last 1 or 2 years have been like mind-boggling. So the next 12 months are obviously not going to give us, anywhere close to what we have seen in the past. And, is the story with IT services sector as well. But still, what we're seeing is that the bottom-up data point, the demand outlook is very strong. In fact, you don't even have to look at the forward guidance given by IT services companies. Just look at their hiring numbers. In the first 6 months of this financial year, the IT companies have hired more than any year in the last 10 years, in terms of the annual hiring. So what we've done in the first 6 months is more than the best full year that we've seen in the last 10 years. So hiring really, really gives us a very good look ahead into what the company managements are looking forward to in terms of the volume growth, deal wins, etc., which gives us a very strong, feeling, which gives us a very comfortable feeling. And of course, we are also mindful of the fact that the global macro is now changing. The investors are becoming more concerned about the global inflation, the US inflation. Now, I mean, you would have seen in the recent commentary by the Fed, they have dropped the word transitory. So, which I mean, it's the first time that they didn't mention this word. So clearly, it points towards a faster tapering, an earlier rate hike cycle beginning. So keeping those things in mind, we do want to keep some defensives, in our portfolio, and IT fits that one as well very nicely.
Interesting. The other thing, Mahesh, in the market is that, clearly urban reopening was a key activity driver. Having said that, ever since the news of the Omicron breakout, you have seen a bit of a, knee-jerk reaction, if you will, in the entire reopen trade. But having said that, would you say that the deep damage is already in the price now? And can one still go out and buy the aviation, hospitality, QSR, as well as multiplex stocks?
Yes, I would say so, Aisha, because every incremental variant of concern has come out with less and less fatality. I mean, the initially, and I'm talking about like global numbers. I mean, initially, alpha was well above 1.5%, beta was 1.5, delta was sort of apparently 1. So I mean, if you just follow the same logic, the fatality of the subsequent sort of variant that we're looking at right now could be 0.5% or even less than that, just going by the global data. So I do feel that, and it's too early to make any conclusive statement on that. I clearly understand that point because it's still very, very early days, and we don't have any sufficient data. But whatever early data that we are seeing right now seems to indicate that the new variant is definitely much more contagious, but appears to be less deadly as of now. And my sense is that the governments all over the world are probably going to not take that severe a view in terms of lockdowns, etc., because what we are seeing at this point in time is that the big tool or the big weapon that the global central bankers used in the earlier variants was the money supply, right, and the money printing by the central bankers. Now that tailwind is clearly not going to be there. Most of the global central banks, either have already raised rates or amidst tapering, or at least talking about tapering. We also here in India, we have seen that RBI has now started shrinking its balance sheet. I mean, very mildly so, but yes, it's still an indication to keep in mind. So my sense is that with these two things put together, one is that it appears to be less deadly, the virus itself, and secondly, the global central bankers seems to be in a bit of an unwinding mode. So the governments won't really go ahead and take extreme steps like severe lockdowns, etc. So yes, you might see some pullbacks here and there, but that will be a good opportunity, in my view, to add cyclicals and add the opening up place.
Mahesh, I want to go back to EV for a minute, because one side is the real market. Tata Motor is getting re-rated, Tata Power has got re-rated, battery companies are getting re-rated. The incumbent players are suffering because everybody thinks that new players is going to eat into their market share, into their profitability. Do you think this EV space and the kind of underlying price multiple some of the companies are commanding and demanding is more like a fad and it's going to get challenged? Because ultimately earnings, and before they kick in, could be 24, 25, 26.
Yeah, I think there's a point in what you're saying, Nikunj, but see, specifically on EV side, we don't really have any large listed plays. I mean, which are like EV dedicated as such. Uh, so it is very much like what was happening earlier, that in India, we didn't really have any good e-commerce plays on the listed side, or on the internet side. And then investors were using all kinds of proxies, be it like courier companies and logistics companies and so on. So my sense is that we don't really have any true blue EV listed plays just as yet in the large caps space really. So clearly investors are looking at other ways of playing the same story. And I don't think that that thing is really go away in a hurry, because especially on the two-wheeler side, the changes are very, very visible. Obviously, those have been aided by the subsidies given by the government, the state and the central government both. On the four-wheeler side, it's going to take some time. But I think at least on the two-wheeler side, the numbers are very, very visible. So yeah, I think you are right. In principle, that we might get to see some some reality check and some corrections. But EV as a theme is not going anywhere in my view. It's here to stay.
What is on the so-called new internet companies? Now we may say that they're expensive, and a purist like you would say, I don't understand cash flows and when the cash flows would be real. But in this market decline, Zomato is still at 150, Naka is still at 2400, while the froth in the secondary listed market is getting challenged. The IPOs, the recent IPOs, they are holding fort.
That's true. So it's like, that's what I said. We clearly have to embrace the new changes that are happening in the economy, and the stock market, I think, is a good reflection of it. So I think the market will slowly begin to differentiate between business models. So yes, the stocks will appear expensive, and many stocks are trading more on the sales multiple rather than EBITDA multiples, or or the profit multiples, and it will take some time. But clearly, the technological change that we are seeing here in the economy, as I said, is here to stay. And I think the global investors are clearly watching out. Also, in all kinds of investors, not just global investors, as to what kind of changes are being brought about, and how the traditional business models are being challenged, how the traditional companies are forced to change the way they work. And yes, I mean, disruption is something that we have seen for last 100 years, right? I mean, it's not that we are seeing this disruption for the first time. Many of the traditional companies have withstood all the disruptions like 10 years ago, 20 years ago, whatever, 40 years ago, etc. So many of them will withstand and evolve with the same. But having said that, we still cannot ignore the force which is driving that change, which is the new age internet companies. So yeah, so I'm just repeating, but I would say that this new internet companies, EVs, yes, there might be some valuation corrections, but the strong business models will be here to stay, and will continue to occupy a large mind share for investors, and those multiples as well.
Mahesh Nandurkar, it's always a pleasure talking to you. Thank you so much for joining us live today on this Monday's edition of The Market.
Thank you for having me here.